In 2012, one of the largest trading firms in America lost $440 million in under an hour. And it happened because of a software bug. Let's dive into it. Knight Capital was one of the major trading firms back in 2012. They were in charge for 17% of all trading on the New York Stock Exchange and NASDAQ, with around 21 billion in daily trading volume. So they were massive. Their core business was market making, basically acting as a middleman between stock buyers and sellers and making profits from the price differences. And they had a reputation of boring and reliable company in a positive way. Important, trusted, predictable, but not really risky or flashy. So they were the opposite of the typical finance bro stereotype. So what actually happened? Knight Capital's trading was powered by the internal trading system called SMARS. Basically software that could automatically place buy and sell orders on the stock exchanges. In 2012, the New York Stock Exchange rolled out a new feature called Retail Liquidity Program, or RLP. Knight Capital, same as all other trading firms of that time, came up with a software update to make sure they can properly process all these new RLP orders. And they successfully deployed this new update on 7 out of 8 servers they had. Why not all servers? Basically, the engineer forgot about this one server, so it was still running the old code. On August 1st, 2012, the market opens, and Knight Capital's trading software goes wild immediately. Basically, it starts buying and selling stocks randomly. Actually, there is logic, but this logic is not very profits-oriented. It aggressively buys and buys certain stocks as their price goes up. And it aggressively sells the other stocks as their price goes down with every trade, basically guaranteeing money losses. The system sends thousands of trading orders every second, generating millions of losses every minute. The Knight Capital team soon realized that it seems like something is wrong. The problem was they had no clear emergency protocol and no kind of kill switch to stop the system. And they urgently started trying different ways to fix the issue. But they could not quickly identify the root cause, so they decided to remove the new software update from the servers and roll back to the old version. So now all 8 servers were running the old pre-update code. The problem is this only made things worse. Now all 8 servers were on a crazy buying or selling spree, generating even bigger losses. Eventually, they managed to stop the trading completely by physically unplugging the network cables from the servers. The trading lasted for 45 minutes, and the system managed to buy or sell around 400 million shares, worth roughly $7 billion. Once the dust settled, they started calculating the losses, and totally they had lost $440 million. This was basically higher than the company's entire valuation, which meant they were doomed. Knight Capital tried negotiating with NYSE to roll back the trades, but the proposal was rejected, as the orders were technically valid and did not exceed NYSE's emergency thresholds. But finance bros are called this way for a reason. Within a few days, several financial companies teamed up and injected $400 million into Knight Capital. On paper, they were saved, but de facto they were acquired by the competitor called Getco. So, what went wrong? As you can guess, the problem was in one server, the one they forgot to update, and it was still running the old code. Basically, their system had a lot of legacy code, including a trading program called PowerPack. It was an algorithm designed long ago for testing purposes, and it was never used since 2003. And they made a huge programming mistake. They reused the old command name in the latest software update. When trading started, this command activated the PowerPack, only in one place, on a single server that was not updated. And PowerPack did what it was designed to do in testing: buy high, sell low, without any limitations. The only problem was, it was not a test environment. It was the real world and real money in the biggest financial market. The Knight Capital case showed how one mistake can eliminate a major company in a single morning. It has become an important case study for the financial industry. Soon after, the SEC introduced stricter regulations around automated trading. Trading firms suddenly realized the importance of proper safeguards and quality control. Everyone urgently started ramping up their engineering teams and implementing new safety features like kill switches. Thanks for watching, hope you enjoyed it. Press like and subscribe as more stories are coming soon. See ya.